Welcome to Three Simple Things, a Gennari Aronson series of tips and information from our corporate and transactional practice. Say you're looking to sell your company and received a letter of intent from a prospective buyer with a proposed purchase price. You're happy with the number, but notice a proviso stating that the proposed purchase price assumes a quote, normal level of net working capital. While that may sound like legal boilerplate, this language means that the buyer expects the purchase price to be adjusted based on the company's net working capital as of the closing. So, what exactly is net working capital and how would such an adjustment work? Let's break it down. Net working capital is an accounting concept that means the amount by which the current assets of the company, such as inventory or accounts receivable, exceed its current liabilities, such as accounts payable or payroll accruals. So in a very simplified example, if you had $300 of receivables and $200 of payables, then your net working capital would be $100. The question then becomes, what is a normal or target level of net working capital, and how does that translate into a purchase price adjustment? Simply put, a working capital target is the amount of net working capital that the buyer expects will be on the company's books as of the closing. It's often, but not always, based on some kind of historical metric such as a trailing 12-month average, i.e. you calculate the net working capital as of the end of each of the last 12 months and average them. When determining the working capital adjustment, the net working capital as of the closing is compared to this target. If the net working capital is above the target, then the purchase price is adjusted upward, and vice versa. The target itself is therefore a crucial deal term, as every dollar by which that target increases is a dollar less that the buyer is required to pay. But wait, you may be thinking, isn't net working capital by definition a constantly evolving number? Throughout any given day, invoices may be issued and bills may be received, so how do the parties determine what the correct adjustment number is as of the moment of closing? Typically, the adjustment at closing, i.e. the actual amount paid by the buyer, will be based on an estimate of net working capital prepared by the seller in a couple of days in advance of the closing. Then, sometime after the closing, typically within 90 days, the buyer will close out the books of the now acquired company and determine the actual amount of net working capital that existed as of the closing. If this actual amount is higher than the estimate, then the buyer pays the excess to the seller. But if the actual amount is lower than the estimate, then the seller will pay back that deficit to the buyer. As always, this is just a brief overview of the working capital adjustment concept. We strongly recommend that you consult with your legal and accounting advisors in connection with evaluating and negotiating any M&A transaction.